Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. If this is your first time joining us, each week when you tune in, you will hear one of two different types of shows. Sometimes when you tune in, you're going to hear an interview-style show where we have on someone associated with the land development industry, and we talk about some industry-related topics. Other times when you tune in, you're going to hear industry news. That's where we pull up a few different headlines, and we talk about what it means for the industry. Now, joining me on these industry news episodes, as always, is Charles Covey. Charles, how's it going?
Hey.
So, a lot happening in the industry. We're going to get into some good topics here that some of which we've talked about in the past. But before we do that, I just want to do a quick housekeeping and reminder to all of you listening in. We did stand up new social pages for the podcast. So on Facebook, LinkedIn, Instagram, and YouTube, you can find us at the Land Development Podcast. And if you're on TikTok, you can find us at Land Development Podcast. So if you're on any of those platforms, search out our page, give us a follow. Would really appreciate it. Since we just stood those pages up and most people were following the business page previously, we're kind of starting over with building our following and getting all of you listening in to also follow us on social media. The more of you that follows, it helps kind of our reach of all of our shorts that we post out there. Getting those out in front of more people. So again, the Land Development Podcast on Facebook, LinkedIn, Instagram, and YouTube, and Land Development Podcast on TikTok. All right, with that said, let's go ahead and get into our first article. First article comes to us from CNBC. Headline reads, Fed holds interest rates steady, still sees 2 cuts coming this year. So for this one, we actually have a video from CNBC. We're going to listen to this video, and then we will discuss.
Federal Reserve keeping interest rates unchanged at 4.25% to 4.5%, but it makes a point of saying that uncertainty around the economic outlook has increased, and the Fed says it is attentive to risks on both sides of its mandate. In a move that we will be debating, it removed the statement saying that risks to its dual mandate are roughly in balance. That came out of the statement this time. On the Fed's projections, it boosted core inflation to 2.8% for 2025 from 2.5%, so 0.3 up. By the way, exactly mirroring the CNBC Fed survey. It kept 2026 at 2.2 and same for 2027 at 2%, suggesting the Fed either thinks it will control inflation through its policy or that any tariff issues will pass through. It did reduce its growth forecast all the way down to 1.7 for this year from 2.1%. and by 0.2% in 2026. So the Fed does see a weakening impulse coming to economic growth. However, in answer to the discussion you were just having, it really kept the unemployment outlook very much unchanged, only a 10th increase in the unemployment forecast. So now you're wondering what they do with rates. They kept the 2 rate cuts in place for 2025, but the dot plot is a touch more hawkish, and I will go over that in just a second. I want to tell you the news on the balance sheet, for which there is some. They reduced the runoff of treasuries down to $5 billion monthly from $25 billion. They kept the mortgage-backed security runoff at $35 billion. Governor Waller, he dissented. Very technical dissent, actually. He agreed with the idea of not to change rates, but he did not want to change or reduce the balance sheet runoff. On the economy, they say it's expanding at a solid pace. They say unemployment has stabilized, but inflation remains somewhat elevated. Now, let me give you the hawkish tilt inside this dot plot here. 4 of the 19 officials wanted no rate cuts, compared to only 1 in the December forecast. 4 see only 1 cuts, and 9 see 2 cuts. What's gone is the kind of, I don't know what you'd call it, the dovish wing of the committee here, where there were 5 people who were looking for 75 basis points of cuts this year. Now there are only 2. So a kind of compression here, leaving the top where it was and some of the bottom coming up. A little bit more hawkish here, but the median still maintaining a forecast or an outlook, not a promise, but an outlook for 2 rate cuts this year. Guys, back to you.
So, Steve, I can't say, look, the market is interpreting this in a somewhat dovish manner. And for me, I'm going right to the balance sheet on this. This is super interesting. And I want to make sure that I kind of explain this clearly and that I understand it clearly. So in essence, the Federal Reserve just decided it's going to sell fewer Treasury bonds, right, from its balance sheet. as it's deciding.
Can I grammatically correct you, Kelly?
Well, yes, I'm oversimplifying.
Only for technical reasons. I don't want to be rude here.
Yeah.
But I do want to say the technical thing is the Fed will allow fewer treasuries to run off of its balance sheet. That is, to run off, mature, and not be replaced. They're not selling. If they were selling, the market would be freaking.
All right, so we saw this last week. Fed had their meeting and made the decision not to cut rates at this point. However, based on this and kind of what the market is expecting, they're still expecting cuts to happen this year. What are your thoughts on this news from last week and kind of what we see going forward?
I think there's just general uncertainty, and it sounds like, based on what they're saying, that uncertainty relates to a lot of the policies. I mean, there's been a lot of stuff happen in the first, 2 months of the presidency. So I don't think anybody knows, including the administration, how things are going to exactly play out. We got a lot of geopolitical stuff that's working in conjunction with the tariffs and a lot of the items that are in play. So probably not a bad choice from the Fed to sit and wait, because I think that the tariffs in general could have an inflationary effect. And that wouldn't be surprising to anybody. We've talked about this, and Trump has talked about this over and over. It's likely that there will be some apparent detriment to the economy. It seems like the economy is having problems based on the tariffs, and then things will normalize. But it is a hump we have to get over, and the Fed's being cautious. So not a bad thing. I think this is probably the right move. Would love for interest rates to go down, and just because it affects me personally and in some of the borrowing that we're doing for our projects. And so I think it affects a lot of people on this. They're listening to the podcast that have development budgets that are, that interest element is significant. So some projects still don't work because rates are high. It just makes us spend more time to try to dial in, the very best projects and keep budgets low so that interest rate isn't such a big factor.
Yeah, so I was just pulling up the Fed meeting schedule here. So they just met on the 18th and 19th of March. Looks like next meeting is on May 6 and 7. And then they designate some of these meetings as being associated with the summary of economic projections. And so the next one of those is June 17 and 18. So we still have we have several more meetings that are going to take place this year that we'll see how the economy continues to move forward with everything that's going on, like you mentioned. I think it feels like very much a wait and see approach, not wanting to jump in too soon and make too many decisions. Because I think the idea is that if inflation is still an issue, they don't want to cut rates. But I know Trump has also been a big proponent of cutting rates. He wants rates cut and everything, but the Fed's not going to make that move unless inflation is under control.
I don't think that we're going to have enough data just based on the lagging nature of the data they use. I don't think we're going to have enough data by May, maybe in June, but I think May probably stays unchanged.
Yep. Okay, well, we'll continue to follow this, of course. I mean, this is something big for the industry, and so we'll stay on top of that as we continue to move forward. But let's go ahead and move on to the next article. This one comes to us from Fast Company. Headline reads, Housing Market Map. Zillow once again downgrades its 2025 home price forecast. Reading from the article, on Tuesday, Zillow economists published their updated forecast model projecting that U.S. home prices, as measured by Zillow Home Value Index, will rise 0.8% between February 2025 and February 2026. That's another downward revision. Last month, their 12-month forecast projected a 1.1% increase in U.S. home prices, and the month before that, they expected a 2.9% increase. The rise in active listings is fueling softer price growth as greater supply provides more options and more bargaining power for buyers, wrote Zillow economists on Tuesday. Potential buyers are opting to remain renters for longer as affordability challenges suppress demand for home purchases. Not only do Zillow economists predict soft national home price growth this year, but they're also predicting that the housing market will only see 4.1 million U.S. existing home sales in 2025. That would mark the third straight year of suppressed sales of existing homes. For comparison, in pre-pandemic 2019, there were 5.3 million U.S. existing home sales. Among the 300 largest U.S. housing markets, Zillow expects the strongest home price appreciation between February 2025 and February 2026 to occur in these 10 areas: Atlantic City, Knoxville, Tennessee, Kingston, New York, Torrington, Connecticut, Bangor, Maine, Rochester, New York, Vineland, New Jersey, Concord, New Hampshire, Norwich, Connecticut, and Fayetteville, Arkansas. And these are the 10 areas where Zillow expects the weakest home price appreciation between February 2025 and February 2026 to occur. Houma, Louisiana, Lake Charles, Louisiana, New Orleans, Louisiana, Lafayette, Louisiana, Shreveport, Louisiana, Odessa, Texas, Beaumont, Texas, Alexandria, Louisiana, Chico, California, and Midland, Texas. While Zillow expects home prices across most of Florida to rise over the coming year, Resi Club remains skeptical. After all, Florida has experienced a significant increase in active inventory and months of supply over the past year, which could signal potential pricing weakness. Indeed, single family and condo prices are currently declining in most Florida housing markets. So, Charles, interested to get your thoughts on this. It looked like a lot of Louisiana housing is going to be decreasing, but there were a couple Texas cities on there as well.
Yeah, that was interesting about Louisiana. So that there's some factors here. I'm assuming there's an inventory thing there. There's a general cooling of the market, maybe jobs based, could be some insurance stuff. There's a lot of Louisiana cities on there. I thought that was interesting. I think so. The Midland Odessa one, that's not shocking because it had huge increase the last 2 years, and now that's starting to cool off a little bit. So no shocker there. That needed to normalize anyway. I think that we're going to see the new home sales are still looking good. It's the existing inventory that's more challenging, and I think in a lot of cases it just doesn't make sense for homeowners. If you need a house, you need to expand, you need more space, you need all these things. In most cases, it just is a better deal to go buy a new home. And so we're still continuing to see the existing inventory be slow, and that's probably going to continue for a while. Maybe there's some kind of factors that we've talked about for a while about due to the rates, due to the rate that someone is already in that home for. It's not that there wouldn't be a buyer for it; it's that they don't want to sell it because they don't want to get out of that particular loan that they're in at 3%. Lots and lots of sub 3.5% mortgages. And if you've ever used a mortgage calculator and done the math, like every point is a massive difference in monthly payment. Like it's kind of wild sometimes to do that. So especially with the interest rates staying pretty stable, I don't think we're going to see a big increase in people wanting to move. I think people are comfortable staying put, and there is that general uncertainty. If your 401k just got hammered, if your stuff in the stock market's getting hammered, and you're looking at this big interest rate scenario, you're going to sit tight. You're probably not going to be looking to move up and get a bigger house or a new house in the near future. So there's just a lot of that scenario, and I think it's going to continue. New home buyers, people that are moving from an apartment or moving out of a family situation and getting a new home, there's plenty of those. Seems like that's still continuing, and new home sales seem to be fine. I haven't seen the data. I know that new home sales were slow in February, and I haven't seen the March data. It's generally expected that seasonality is pretty normal. We hadn't seen as much seasonality the last couple of years, but previous to that, seasonality had been a major factor. So I'm really interested to see. We probably should watch this in March. Maybe something to add for future is to see what are the new home sales looking like in these growth markets through March, and what is that spring boom that typically would happen with the seasonality. How's that look? March, April, May is big for new home sales. So we really want to watch the new home sales and see what those look like. I think that's a big indicator for us to follow.
Yeah, so March sales, home sales data should be available to us by our next episode or the episode after that. So we'll definitely want to touch on it. What's interesting,
check-in, even if we don't use it as a topic, but I think a quick check-in on that data point the next 3 months, I think that applies to nearly every person listening to the podcast. So I think that's a big one for us to see. How is that trending? It's a lot of people waiting for that info, just because January, February was not very impressive.
Yeah, something interesting. So this last week, when I was at the barber, so my barber is actually in the market he wants to move out of his existing home into another house. And so I got to listen a little bit to the psychology of him and like how he was going through the thought process
What's that like?
Yeah. So he, he was definitely, so he's about our same age. And so he was thinking
You're
back.
lumping me in with you, and I think I'm older than you. So I appreciate that, though. Thank you.
Well, anyway, I think that he was thinking back to the times when the interest rates were not 2% or, really, really low. So in his mind, he was looking at it from the standpoint of, hey, rates aren't that far off from where they probably will end up stabilizing. And that will have kind of a newer floor for where rates are going to be. So he was justifying that he's not going to let rates stop him. Now, the thing that he is going to be looking at is if he's looking for a new home and, and he's working with a builder or builder developer, he's going to be looking for something to help offset certain elements of that, though. And so it was just kind of interesting hearing him talk about it. So it's not stopping his search. It's not stopping him from buying, but he does have, it sounds like, some concessions that he'd be looking for, some sort of savings that he can get versus going out and, buying a brand new, new built home versus an existing one. Because I think his big problem is that it's hard to find existing homes on the market right now that he's interested in moving into. It's more so he's having to look at the new home market. And that's just a little bit different of what that looks like today and everything.
Yeah. And that seems to be happening in most of the markets that I'm familiar with. Similar scenario.
Yeah, exactly. This episode of the Land Development Podcast is brought to you by Groove. Prospect land, organize research, and manage deals all on one centralized map. Keep your entire team on the same page with notes, documents, and deal activity all in one place. Start your free trial today at letsgroove.com /signup. That's letsgroov.com/signup. All right, let's get back to the show. All right, well, let's go ahead and move on to our third and final article here. This one comes to us from Globe Street. The headline reads, CBRE warns of tariff impacts on CRE. Government policy uncertainty will drive volatility and weaken sentiment. So reading from this article, as the April 2 deadline for a 25% increase in tariffs on a wide range of imports from Canada, Mexico, and China draws near, industrial and retail property will see the most immediate impacts if consumer spending weakens and the flow of goods shifts, according to a new analysis from CBRE. We expect that some large industrial occupiers may delay signing leases in the near term, with third-party logistics companies accounting for a larger share of leasing activity as more businesses rely on them amid uncertainty, the report noted. It does not expect the recovery in the office market to stall unless there is an economic downturn. It notes that many economists believe the tariffs are likely to slow short-term economic growth and increase inflation, though in the long term, tariffs may spur some domestic manufacturing. The report cites estimates that tariffs would raise typical household costs in the U.S. by $1,200 a year and increase the cost of buying a car by at least $4,000. These higher costs are expected to trim about 0.4 percentage points off U.S. GDP growth this year, the report stated. It added that the Fed's core personal consumption expenditures index would likely rise 0.4 percentage points more than expected to average 3.1% in 2025. Interest rates would also rise unless held down by a weakening labor market. In 3 to 5 years, domestic manufacturing could add 400,000 jobs in the U.S., but this figure does not consider the U.S. jobs lost due to lower exports as countries retaliate. The report cited projections that construction costs for commercial projects could climb by 3% to 5% based on the 25% tariffs imposed on Canadian and Mexican products and the higher tariffs on Chinese goods. This could cause developers to hold off on some projects. The report said the effect of tariffs will be felt in CRE more heavily by multifamily than by industrial. However, given the oversupply in some multifamily markets, delays caused by less new supply could give the sector some breathing room. In the midst of all the unknown, CBRE said savvy investors could take advantage of the uncertainty to wangle more favorable prices. In the short term, the uncertainty will fuel financial market volatility and dampen business sentiment, leading to less investment. However, we still expect a generally supportive backdrop for CRE investment, including continued, albeit slower, economic growth, along with at least 2 Fed rate cuts and a 10-year Treasury yield stabilizing to close to 4%, the report said. So what are your thoughts on this, Charles? Anything surprising with what is expected to happen, or their expectations based on the tariffs?
Yeah, so I think that what I'm seeing, and I'm involved in some acquisitions, and the stuff that we're looking at acquiring is more blue collar businesses, and that's where a lot of our diligence is. So diving into those, what is the tariff risk? What are the ways we can mitigate that risk for those companies? And it seems to be that there are some more at risk depending on their suppliers. And I think there's a general interest to reshore their supply chain, try to have more things purchased domestically, and have less tariff risk. So that is kind of a general element. Same thing with the stock market. Same thing with the Fed. Applies to manufacturing. There is uncertainty, and so when you have uncertainty, most normal human reactions is to kind of pause and wait for things to play out. And that's probably the right move. There are some businesses that are still, head down, still moving forward. And that's usually in a case where they don't feel like they have a tremendous risk on the tariff side. But businesses that do have supply chain risk with tariffs are waiting to see. So you're not seeing them do a big expansion. You're not seeing them, do any kind of big capital outlays because of that uncertainty. And that's just how humans behave. So we would see that in any market. So I think we're going to continue to see that uncertainty as things play out. Maybe by summer we have enough info. I don't know. It's tough because there's a lot of geopolitical stuff that's playing out that we still don't know how this is going to go. So I would hope that by summer we have a little more stability in the marketplace and things can move forward. I think generally speaking, once we know how these are going to play out, people are working to reshore their supply chain. I think that there's plenty of room for CRE to keep growing, keep booming, maybe even experience a great period towards the end of the Trump presidency. So very positive in general, but I think that uncertainty is just causing things to be relatively flat at the moment.
Yep. And a little off topic here, but I can't say that I've ever heard the word wangle.
Yeah, I think it's supposed to be wrangle.
I thought so too, but then so I looked up the definition here because I wanted to educate myself on this word that I've never seen before, and it says wangle is a verb, or it can be a noun, but verb sense. Manage to obtain something by persuading or cleverly manipulating someone. I wangled
wangle's the perfect word for this
party.
based on the definition.
So there we go. But now we all have.
I immediately thought, okay, who is using this? Who, and in what school did they learn this particular word? Because it's not one that's. I mean, I grew up on a farm, and we didn't have big words like wangle, so this is new. This is new for me.
Yeah, I'm with you. When I saw that and I read it, I'm like, that had to have been wrangle. It had to have been
Texas A&M, they didn't teach us this particular word. Wrangle for sure, but wangle definitely not.
Yeah. All right. You all have a new some new vocabulary to use now in your everyday.
Yeah, this is what we do on the Land Development Podcast. We're just trying to edify and increase your vocabulary.
There you go. Well, that's the last of our articles that we had for today. Anything you want to leave the listeners with?
Well, I think there's a few things that we want to make sure that we're giving good information and that we're providing valuable information to the listener. So I think a few things that we're going to pay close attention to are the new home sales and existing home sales. So I think we want to monitor those because those are two separate categories. The new home sales are the one that applies to a lot of our listeners specifically because the trickle down, whether you're just doing lot development or whether you're a builder, like this is a big deal. So I think we want to watch that and then also track what the existing home sales is doing, just because that's a notable element. The uncertainty in the marketplace is very clear. You got stock market issues. We're seeing that a lot with investors that we work with. They've either pulled money out of the stock market or they are about to or wanting to. So that's changing kind of the landscape of how investment is happening. Usually that they're seeking security. So that's a flight of dollars to security out of the stock market. And security generally is things like real estate. So it's actually a good time for real estate investment. And it's just them trying to decide what is the best real estate investment to go into. So I think a lot of good things happening, but up to us to provide good information, and we'll continue to do that on these episodes every 2 weeks.
Yep. No, well said. So all of you listening in, if you're not already subscribed, would really appreciate you clicking that button and subscribing to the show. We've got a lot of good episodes continuing to come up. You'll continue to see Charles and I as we do these industry news episodes every other week, and bringing you some, all the news and information that we can on the industry to be as helpful as possible. And then also, if you haven't left a rating and review on whether you're on Spotify or Apple Podcasts, that goes a long way in helping our show kind of spread and have more people find us as they're searching for this type of content. So appreciate you as always tuning in, and we will talk to you all next week.